Room air conditioner and small domestic appliance manufacturer Epack Durable's IPO is all set to open for subscription. The company earns about 80% of its revenues from room air conditioning. It's a manufacturer of room air conditioners. It's also in the process of increasing its capacity by 3.6 million units a year after the company raises money via this IPO. The company has also been a beneficiary of the incentives under the White Goods PLI scheme. To discuss the issue, the business plans, we're now joined by Mr. Bajrang Bothra, the chairman of the company Epack Durables, and we have with us the CEO of the company, Mr. Ajay Singhania, MD and CEO. Gentlemen, thank you very much for joining in. Epack is a consumer durables company, but you get 80% of your revenues from room air conditioning, manufacturing of it, and 20% from small domestic appliances like induction cooktops, mixer grinders, water dispensers. So an overview of the company.
We started our journey in manufacturing air conditioners as an OEM in 2003. So, it was a partnership company started in 2003. So, air condition has been one area which we have been doing for past 2 decades now. And since air condition has its own seasonality, we realized it way back in 2011-12 that to maintain our better asset utilization and the fixed cost to be rationalized, so asset turn, we got into manufacturing of small domestic appliances, which is predominantly a second half of the year business. So that kind of helps us rationalize our capacity utilization and utilize our assets better. So that was the whole idea with which we got into the small domestic appliances.
You see, cost effectiveness is the key to market leadership. And without cost effectiveness, market leadership cannot be arrived. So the basic DNA is that we have to innovate, we do a lot of R&D efforts, and then the backward integration, which leads to cost effectiveness. So, and I think for better asset utilization, this SHA, as Ajay says, small appliances is there.
So half of the year, your manufacturing capacity, your plants are used to manufacture ACs, and for half of the year, it's used to manufacture the small domestic appliances, because ACs is a very seasonal business.
Absolutely, absolutely.
Okay. And what is the capacity utilization you operate at?
See, the capacity utilization varies from month on month, but the good thing is the small domestic appliances help us utilize the assets better during the off-peak AC season. So that's like an added-on advantage.
Okay. So the ACs that you manufacture are sold under which brands?
So see, out of top 10 brands in the country, almost 7 of them have been our customers with an average retention of more than 8.5 years. So that's what our retention has been of customers. So we do it for most of the reputed brands, both national and multinational.
So Blue Star, Daikin, Carrier, Voltas, Havells, these are some of your clients.
Yeah, absolutely.
But you don't have an exclusive tie-up with them. Even other consumer durable companies can manufacture for the same top 7 AC companies. Is that right?
Absolutely.
Okay. So what is your market share then in the room air conditioning business?
Air conditioning is a very interesting thing when it comes to manufacturing, because most of the brands also have their in-house facilities. But the overall Indian market, almost 35% of Indian AC manufactured and manufactured by OEMs and ODMs, of which Epack Durable has more than 24% market share as on FY23, based on the Frost & Sullivan study.
24% market share.
Yeah.
This is
of the ODM space.
Of the entire ODM. And you're not the market leader. You're the second largest manufacturer.
Yeah, we're the second largest manufacturer.
So who's the largest and what would their market share be?
So Amber is the largest.
Amber, okay.
Yeah.
And their market share would be?
Based on Frost & Sullivan study, it's close to 48%.
48%. And how has your market share changed over the last 5 years? Has it been going up?
Yeah, definitely. So, over the last 3 years, if we look especially, we have gained a lot of market share. So,
what was it 3 years back?
Probably it was somewhere less than 10%.
Okay, sub 10%.
Yeah.
Okay. So there are many EMS companies listed on the stock exchange, but Amber is the one which is directly comparable to you. Your revenues roughly were about 1,500 crore rupees last year, 1,538. But Amber's top line is much larger at nearly 7,000 crore rupees. Can you tell us the quick differences between Amber and Epack Durables?
See, it is really hard to differentiate between two OEMs and ODMs just in terms of the top lines. See, we know what is our basic DNA. Our basic DNA is that we are an ODM, which means we are almost 100% original design manufacturer. So our DNA is design product, and we deliver the complete built unit mostly to most of the brand customers, both for the home, the air conditioner as well as the small domestic appliances. So ODM is our core, and we believe in that, and this is how we have grown organically only. So today we have only 3 manufacturing bases. The first one which we started off from Dehradun, and then we had the second base in central part of India in Bhiwadi in Rajasthan, and then recently we have started a new facility in Sri City near Chennai. So we are concentrated only in 3 manufacturing zones, in 3 manufacturing clusters, and each of these clusters are almost entirely backward integrated when it comes to manufacturing components of an AC.
Okay.
So we do almost 65 to 70% validation in-house. Practically, if we talk in terms of an air condition, except the compressor, we make almost all the parts required to assemble an AC in-house.
So you can make the component, you design it, you manufacture the component,
Absolutely.
and then you will assemble, and then you will sell it to 7 out of the large top 10 brands in India and globally, with a market share of 24% of the ODM space.
Yes.
ODM and OEM space. Got it. Now, in the large appliances in India, the market share, or not market share, or the penetration of televisions is a lot higher, or they occupy a larger percentage of the overall spends, and I think it's close to about 50%. So why are you not present in the other spaces? Why are you focused only on RACs?
So that's the right question. I think that's the right timing why we have come up with an IPO. I mean, that's the most exciting part of the journey we are into. At sub 8% penetration per household, I mean, you can just imagine the potential AC industry holds to grow in the future. I mean, AC amongst all the appliances, amongst all the peer appliances, let's say in a washing machine, a TV or a refrigerator has the lowest penetration.
Okay.
8%, like you rightly said, against the global average of 42%.
Okay.
And some countries like China have more than 100% penetration. See, especially when it comes to AC, we need to understand that the probability of having an AC is more than one per household. You need at least 1 AC per room. And in terms of today's, the way the living standard has gone up, we see the penetration improving and increasing year on year. So with the potential of having multiple ACs per household, 8% is something very low, and hence the potential is the highest. So I think we are in the right industry.
But what about the other industries like television? Because you've also said in the RHP that you've entered into a memorandum of understanding dated September 2021 with East India, where Epack cannot manufacture products which are made by East India, which means it excludes you from audio camera equipment, desktop computers, laptops, renewable energy electronics, TV, lighting equipment, which means a very large portion of the market is not available for you.
Yeah, right. So, see, the core of Epack Durable has been appliances, and this is where we have grown. So, we understand our core, we understand what is our DNA.
What is this MOU, and who is East India? I mean, what's the connection with you and East India?
So, East India is a sister company of Epack Durables.
Okay.
So that company focuses on EMS business, and so we had a shareholder agreement between the two families that Epack Durables will grow in its particular domain of home appliances, and East India will grow in its domain of consumer electronics.
What do you mean by a sister company? Is it started by family members or?
Yeah, so it is 100% owned by the Bothra family. So like I shared in the beginning with you, Mr. Bothra started his own venture in 81 after his graduation, and myself and my brother Sanjay, we joined Bhaiya in 99 after our graduation, and we jointly started the appliances business and the other businesses all together. Today, in all other businesses we have, both the families, we own 50% equity each. I mean, amongst the families, it's 50-50 each, except the electronic business, what we're talking about.
And there's huge potential in the air conditioning space.
Fair
and
enough.
then
Penetration of 8%,
going forward,
etc.
I think when we started small appliances, and then now going forward, we're going to start large appliances also.
And this MOU with East India, the sister company, which is 100% owned by Mr. Bothra, which excludes you from a large chunk of the consumer durable market. This non-compete, in a way, is for perpetuity, or is this for a 5-year?
It's a time bound. It's a time bound thing. So I think it's already been more than 3 years that we signed it.
Yeah, September of 21. So it's for how long?
I think 5 years.
5 years.
Best I remember, but I'll check.
So it's a 5-year non-compete.
But family has such a great understanding that in case opportunity comes to Epack Durables, I think the family is flexible enough to give opportunity.
5 years later, would you be open to venturing into televisions, refrigerators?
Absolutely.
If we say an opportunity, refrigerators anyway excluded from the agreement. So yeah.
So
the current
TVs,
focus
laptops, etc.
So if we refer to the RHP, we'll see that we have listed a whole lot of appliances what Epack Durables is looking at. So currently the consumer electronics is not in the foray of immediate, let's say, another 2-3 years.
What are the appliances that you're looking at in the next 2 to 3 years?
See, we have identified appliances, what we call the non-air conditioned larger appliances. Some of them could be something like a cooler, which are like larger appliances enough.
Okay.
And then we are also like to keep our steady focus on the second half of the year business, we are developing a lot of smaller domestic appliances. Like we already started doing mixer grinders. Now the entire mixer grinder category, the juicers, the hand blenders, Then
Induction
induction cooktop is what we are already doing. So
already have that.
related things like induction water heaters. So there are a whole lot of personal grooming products like hair dryers. So we have teams dedicated which are doing exploring the possibilities of. Sure.
Your revenue growth rate has been fluctuating quite a bit. In FY23, it was 66%.
Yeah.
In FY22, it was 25%. In FY21, it was a negative growth. But I understand that could be on account of COVID. But even then, it's a pretty large fluctuation, 66% last year versus 25% in the previous year. What's the steady growth rate from the company on the top line we should expect?
See, our real journey as an OEM ODM started in the year 2019 when we converted the company from a partnership to a private limited company. And so this is when we got the infusion of private equity players in 21 and then another round of private equity infusion in 22. So that has all set the ball rolling for the company to get into a growth phase. And a steady state rate like last 3 years CAGR, if you look at it, is almost 44%. So, I mean, that's the steady state growth rate. Obviously, to compare anything with 2020 and 21 would not be justified because both years were COVID.
45% revenue growth going ahead?
I'll keep my fingers crossed.
Okay, because the market, RAC market is only growing at 15% according to Frost & Sullivan.
Yeah. So the market has been on a good growth path. And more than that, I think we have to look also at the Indian economy. I mean, the absolute growth is almost 12%.
Okay.
Before the private equity came in, I think we had very limited capacities. So after this, we have gone for great expansions. Okay. And since our fill-fail ratio is the lowest in the industry, so every customer is supporting us. And I think we hope that we will get a good business now, all the customers going forward also.
What about margins? Margins have been in a band of about 5.5% to 7.5%. You end 6 months FY24 with margins of roughly 6%. Are these the margins, 5, 6, 7% that we should work with going ahead?
See, the industry average is almost similar, 6 to 7%. But the good thing about Epack Durable story is that we have consolidated manufacturing base. See, the entire idea of us creating a consolidated base with all the backward integration in the same facility is the trick which we believe is going to work for us. And the whole idea here is that if the
can you expand margins because of your focused manufacturing base?
Absolutely.
You can increase margins?
See, what we believe is this gives us an edge in the sense that a lot of logistics between intercompany is avoided. We have better control on the inventories. We have better control on the entire process. So that has been the whole idea. With which we have done this backward integration over the last 2 and 3 years, and we have to see the results in the coming years.
And to increase the asset turn, I think all the assets are fungible when we make for small appliances and large appliances, the same asset base used for that. So we don't have to go for additional very high capex.
So in one word, if you had to say margins from here, steady or increasing, what would you say?
It will be a forward-looking statement. Definitely what I can say is, like we have projected in our RHP, there are a lot of products under development which will help us rationalize our capacities going forward, help us utilize our capacities going forward. And so that is the strategy.
Got it. Let me talk about
the working capital management strategy also is, a lot of focus of the management. So going forward also, it's also going to pay off. Okay.
Let me talk about your dependence on imports in China. The cost of goods imported is 40% of the total cost of material in FY23 versus 27% in FY21. And the cost of materials imported from China is 34% versus 14% in FY21. So imports is also fairly high. And even the dependence on China is on the higher side. Talk a little bit about this, and is this a bit of a concern? Would you look to bring it down?
See, I think the two relevant years, what we are comparing here, 21 and 22, don't really make much of a sense because 21 was hit by COVID. So a lot of inventory was carried forward from 20 to 21. So there could be some imbalance in terms of the inventory being carried forward. But in general, if I look at the industry as a whole, the import dependence on China has come down substantially.
The industry or for you?
For industry, and then the same would be applicable to us as well. In real sense, if we talk in terms of that particular financial year. So our earlier domestic, our own in-house manufacturing was close to 35 to 40%, which today has almost come up to 60-65% in terms, except the compressor, since we make almost everything in-house. So in terms of an AC, it would be almost 60 to 65%. And similarly, that means the import dependence actually gone down.
So you're saying earlier the import dependence on your materials required was 65%. It's come down to 35%.
Yeah, broadly, yes.
Broadly.
And that's, I think, also applicable to the entire industry as a whole.
Okay. And will this come down further? should?
See, the way, I mean, we are actually thankful to DPIIT and the Ministry of Commerce for having the air-conditioned PLI in place.
scheme, yeah.
So, some benefits have definitely come, one of which is that our import dependence as an industry has come down. And going forward, some critical raw materials are still imported, for which a couple of clearances are awaited. So, we are awaiting some more industries to come up to support the industry for requirement of the critical raw materials, especially copper, aluminium.
So this IPO now, it's 400 crore of a fresh issue, 240 crore of an offer for sale. Out of this offer for sale of 240 crore, roughly 50% will be sold by the promoters. So your promoter holding is currently 85.5%. What will it come down to?
It's not 85.
Sorry, what is the number?
So currently today is close to 65%.
65. And what will that number come down to?
Almost 50%.
It comes down to 50%. Okay. And why the promoters bringing this stake down?
This is a one-off liquidity event for us. So I think we have a lot of aspirations for philanthropy and all that. So I think it's required for that also.
Okay, got it. And the other investor who is selling the balance 120 crore?
Yeah, so we have currently two private equity investors, ICICI Venture Funds, Augusta Capital, and one more is there. So they invested in FY21, September 21. And there is another private equity industry player by the name of Pharma Capital who invested in September 22. Okay. So ICICI Venture Funds are exiting only part of their, liquidating part of their equity.
1/3 of the equity.
One third of their holding. Yeah.
And this fresh issue, it will be, raised 400 crore of a fresh issue, which will be raised for two key reasons. One is CapEx, where you will be utilizing 230 crore, and about 80 crore is for repaying part of your debt. Yeah. So let's talk about your CapEx plans. What is the current capacity? Because you've said in the RHP your capacity increases by 3.6 million units. So what is it currently?
So currently the capacity is 3.7 million as per the RHP.
3.7 is the current capacity.
3.7 million units is the current capacity.
Okay. And what will it increase to?
So it will increase when the 2.4 million. Yeah.
2.4 million. Okay. So you will have 6.1 million capacity.
Yeah, roughly 6 million.
Okay. And if you can operate at the current capacity utilization you're operating at, what could your revenues go up by?
If we have the capacity, if the market supports us 12 months a period, we can produce 3.7 million units, definitely, yes.
But you want to tell us roughly what's the capacity utilization?
It's a very highly seasonal business. Let's put it this way, based on the Frost and Sullivan study again, they estimate the industry average of utilization is close to 50-55%. That's the industry average.
And now you're borrowing 80 crore is what you're looking to pare down your debt. Yeah. Your current borrowing figures, I think 370 crore?
See, out of which almost 190 crores is the debt, and then rest is the working capital limits, so utilization of the limits. Okay. So when we bring it down by 80 crores, it will be roughly around 90 crores. Would be debt.
No, 190 crore of debt comes down by 80 crores.
Yeah, yeah.
So 110 crore of debt.
Correct.
It's 170, 180 crore roughly. So by 80 means it will be somewhere in the range of 90 to 100 crores would be the debt. Yeah.
90 to 100 crore. Okay. And the contribution of your top 5 customers is very high at about 80%. And the contribution of your top 10 customers is even high. I mean, it will be higher, but it's above 90%. Yeah. Is that a bit of a worry for you, this over-dependence on key clients?
See, AC industry is structured in this way, Rima. We need to understand that we have close to 60 brands in India who sell air conditions. Okay. And then if you look at the top 10 brands, they contribute to almost 85% of the overall market.
Top 10 contribute how much?
Almost 85% of the overall India market.
Got it. So it's a function of the industry itself, and you cater to.
Yeah, yeah. And we cater to the top 10 brands.
Top 7 brands out of 10. Got it. And are you looking to make inroads in the balance 3 brands, or you must have tried?
Yeah,
that's gaining customers, process. Increasing wallet share definitely is what all the companies strive for.
What about this?
One more thing, Rima. See, this PLI scheme is going to be a big boon for the industry and for us as such. Because you see, the whole idea of this PLI is to create global champions in component manufacturing. So once we scale up the component business, which we are investing in, I think globally also we will become competitive in next 2-3 years' time. So when we open up the global market, the export market, it's going to be humongous. So now when we talk about the capacity in the Indian market, it may be limited now, but it's growing by 12 to 13% every year CAGR.
So do you all have exports right now of anything?
Yeah, so we do currently export to, but as an industry, the exports of India is very negligible. Yeah, we do export to some Middle East countries and Sri Lanka like that.
As a percentage of your revenues, exports?
It will be almost negligible, let's say less than 1%.
Okay, less than 1%.
Yeah, so this is what Mr. Bothra was trying to say, that the whole idea government came up with the PLI scheme. I mean, besides increasing the Make in India thing, the whole idea was to also look at Make in India to supply to the world.
Yes.
Yeah, yeah. And so that's something, if India is, let's say today, a 10 million AC market, mota, then the market outside India, I mean, except China, is another 100 million. So that's 10 times the size of India market, 10x up.
So are you looking to export now?
So that's an opportunity which will open up for the entire industry. I mean, as we get more competitive as a country, as an industry, definitely that's an opportunity.
Do you have any aspiration? Exports is less than 1% of your revenues. Do you think it can get to 5% in 2-3 years with increased capacity?
The aspirations are always there. Why not?
You have export aspirations.
Definitely, because that's a market potential we have to really penetrate in.
So this PLI scheme has given you about 7.5 crore of revenues in the first half of the year and 15 crore of revenues in FY23. Is this annual run rate of 15 crore we should expect from PLI incentives?
Yeah, so Rima, there's a cap on the PLI incentive.
Okay.
So there's both an upper and a lower cap on it.
Okay. So what is the range then, upper and lower for you?
So it's linked to the investment. So like for the next, so it was like we committed investment of 300 crores in Epack Durables in PLI, in plant and machinery. So that investment was 50, 50, 50, 75, 75 in 5 years. And the following year we are supposed to get 6%, 6%, 5%, 5%, 4%. So that's a well drafted policy.
Okay. So for the next year also it will be 15 crore.
So it's for the 5 years, yeah. Till
it will be incremental, because incremental sales, incremental investments, incremental, this, you know, suppose this year 50 crores, we get 6%.
So in 5 years, with a commitment of 300 crore, what could be the PLI?
Roughly 220 odd crores is what is going to come back in as...
It could be the maximum incentives.
Maximum incentive. Maximum, minimum both. I mean, if we meet these targets.
So far you've only managed to hit about 20 to 23 crore.
So last year was the first year.
So 15.
So, yeah, when we got 15, and now this is the second year. I mean, FY23-24 is the second year.
So this year, when we cross 30 crores, 500 crores of additional turnover, we'll get 30 crores.
Okay. Thank you, gentlemen.
Thank you
very much for joining in, and wish you all the very best.
Thank you.